Hello, everybody. Welcome to the live stream. We be getting started here in just a second. Let me switch my sharing correctly. There we go. And now we're all set. Really excited for everybody who's here. We will hopefully even get a few more coming in as we get things rolling. But really quickly, just I'm dropping my email in the chat area. Please feel free to use the chat for questions or comments that you have during the live stream. That way we can do more than just focus on what I talk about. We can try to fold in your comments and thoughts into some of the other things that we talk about today. Um, so my email address is rebelincomesystem@gmail.com. A couple of other ways that you can interact with me and with Rebel Income for that matter, depending on which platform you're on or which you prefer. I'm just going to really quickly, and I know this is maybe a little bit redundant for some of you, but by way of just review, if you're on Discord, there is a channel called Open Discussion. And this is an area that everybody that if you have access to this live stream, if you're here live, then you have access to this. This is an area that I've set aside for everybody who's on Discord to be able to interact with each other. You can also do the same on Substack. Let me go really quickly here. The chat area is another way that you can go ahead and you can interact with me or with the group. So I've set this up to work, whether again it's Discord or Substack. I pay attention to these throughout the course of the day, and will respond to these messages as soon as I get them. I also try to respond to emails as soon as I can. All right. That said, I think that's probably enough. As always, it is Friday. It's the first Friday of February, so that means we're starting, not only kicking off a new month, but as always, there's always weekly options that are set for expiry on Fridays. And so I do have a trade that is set for expiration today. We'll have a chance to go through that. Also, a number of other positions that we'll be able to review, and hopefully have some time to get some of your thoughts, and maybe even do a review of some stocks that you're following as well. Have an opportunity to answer questions or concerns that you have. So let's go ahead and dive in. I want to start the discussion. This isn't housekeeping, but just kind of do a really quick review of where we are in terms of the overall market. This is a chart for the S&P 500. If you need me to try to make this a little bit bigger, please let me know if you can see it okay. We can see that the S&P 500 is right now it's selling off a little bit. There's some fears about inflation and what the net effect of tariffs, not only what the U.S. imposes on others, but also the after effects. There's a give and take, a back and forth associated with tariffs, right? That we have to contend with, and there's some uncertainty that arises as a result of how that's going to impact economic activity, inflation specifically, and so that's the reason we've got a little bit of a sell-off today. It is just kind of confirming what we've been seeing for the past few weeks, which is a lot of consolidation. Sorry, give me just a second. Let me get my drawing tools up. There we go. Okay. We see some consolidation right now, and consolidation is neither good nor bad. It's really just where the market in an upward or downward direction. And so what we see is mostly a sideways trend. And I know these lines are ugly. I apologize for my artwork. It's just not great when I'm trying to do this with a mouse. But we have top end. We have top end activity for the S&P at about 6,100, and then on the low end, I know it's been below this a couple of different times, but we can probably put this at around. Oh, let's see. It's not quite 6,000, is it? Try to line this up a little bit. There we go. 5,900 is probably about where that would line up. Use a different tool. There we go. Yeah, roughly 5,900. Maybe a little bit below that. So somewhere below 5,900 and 6,100 is kind of the range for this consolidation that we're seeing in the S&P 500. This isn't a pattern that's all that dissimilar from what we're seeing in the other markets. The range is a little bit different, but again, kind of also, this is the Dow. We're seeing it's also failing to pierce these previous highs from December and earlier in January. So that's a similar phenomenon right now. And then on the NASDAQ and the S&P 500 right look quite a bit more similar to each other than say the Dow does. Top end and lower end. So we have these ranges where the market right now is just it's kind of in a holding pattern, and that doesn't mean that doesn't mean that it's waiting to go higher or getting ready to correct. It just means that it's waiting to really try to find its next foothold. That creates uncertainty, and uncertainty is something that often is going to create some additional volatility in the market. That means that the stocks that we're following, we're going to see higher levels of swings in price from high to low points, and that's going to create a little bit more uncertainty. You're going to see some. What does that mean for the average investor? If you're in bullish positions and you're profitable, this is a good time to think about maybe taking some money off the table. I'm not saying selling out of all of your positions and going to cash, but it may mean selling off a portion. If you've got several hundred shares or more than 100 shares in a position, and you're in a profitable position, maybe you sell a portion of that position. You'd hang on to those profits and decide if you want to stay in it or get out altogether. It just really kind of depends on what your perspective is. But we do see the market. We do see this weighing on the markets right now, and so that is creating. If you just kind of here's my watch list. A lot of red and a little bit of green, but a lot of red right now. Okay. Now, as far as our trades go, I mentioned I do have one that is on deck, and that is gold, Barrick Gold. This was a put sell that I placed on the 22nd of January, and using the 50 strike price, and brought in about 25 cents. Doesn't sound like a whole lot, but it did give me about 1.6% for 2 weeks, which is more than useful enough for my purposes. And so that was a trade I was happy to make. Let's go ahead and take a look at where gold is today. Remember, this is precious metal, but we're talking about Barrick Gold, the company, rather than the precious metal itself. And stock has been seeing some really nice momentum for the last few weeks, and especially this week, it's really kind of picked up its pace. It was around 16 to start the week, and now we see it selling off a little bit from a peak near a little bit below 1750. It's at 1714 right now. So all things being equal, it looks like this position is going to expire worthless. That's not a terrible thing. That's all right. Let me switch here. Sorry. I usually like to use this chart for my indices. Let's go back here. And here's Barrick Gold. Sorry, while I was talking, I got myself crossed up in the charts that I want to use. Okay. So this is starting to come up. It's starting to approach resistance, and as a result is coming down. So right now it looks like this is going to expire worthless unless something really impressive happens in the next couple of hours. But it's got to get all down to 1550 before I'm at risk of being assigned. And so here is contract. And we can see there's no bid, 1 cent on the ask. If I wanted to try to take advantage of that significantly bullish position right now, thank you, Barry. Mine is set to expire next week for the same 50-50 strike. So you went out a little bit longer, probably got more premium than I did, but again, it's in a nice position right now. We'll take a look at yours. If I want, but really quick, before we review Barry's contract and kind of talk about what your alternatives are here. You know, obviously I'm in a good position. I can just sit here and let this expire worthless. And this is my normal MO. Once I place a put selling trade, I let it run through expiration. And what happens is what happens. That means that if the stock is in a position today, then I'm going to let it expire worthless, and that's fine. But it also means that I have to wait for the trade to for the trade to settle. Apologize for my misstatement here, but I have to wait for the trade to settle, and that's usually, depending on the broker, 1 to 2 days. What that means is that the capital that I put in to reserve the trade, and I used 3 contracts to place this trade, so it was about $4,650. Just make sure that my math is right. Times 300, 4,650. There we go. $4,650 is the money. This was a cash secured put sale for me. So that means $4,600.50 of the cash in the account was placed on reserve for the duration of the trade. And so it takes the day or two for that to settle. That means that the earliest that $4,650 would be available again to use for a new trade is going to be Monday or Tuesday at the earliest. Now I'm okay with that. This is the way that I've found to let the system work for me, and that's okay. There is an advantage though if you want to be a little bit more aggressive and think about whether or not to buy it back before the market opens. If you want to preempt me, if you know where I'm going, feel free to put it in the chat for the benefit of everybody else. But one of the things that you can do, especially if you want to think about placing a new trade using the same stock, for example, you want to be able to use that $4,650 more quickly. You may want to go ahead and buy it back now. This is not a recommendation, obviously. I'm only kind of describing some of the things that are advantageous about doing this. But even doing this before the market closes, if you buy this option back now, if I were to do this, it means that $4,650 would come back into my account right away, be available to trade. As long as I do it before the market closes today. It's one of the interesting distinctions between letting it expire or trying to be a little bit more active. So with that in mind, if I still wanted to continue to work with Barrick, what could I do? Well, If I go out another week, it's kind of interesting. 1650, there's 19 cents available for that. It's not a ton, it's a little over 1%, but that's for 7 days. That's a 1 week trade. If you're not okay with 1% for 1 week, I don't think we have to annualize that. Just multiply 1 by 52. If you can't find that, find a way to justify that trade. Okay, maybe put selling isn't for you. But even if you wanted to be a little bit more aggressive, this is interesting. 37 cents for the 17. So Barry, this is maybe this is a nice segue to your contract, right? I don't know exactly how much you got, but here's 5 cents on the ask for February. If you got anything close to the 25 that I got for mine, and I'm going to assume it's more, I'm not going to tell you what to do. Yeah, 36. So if you bought this back for 5 cents, you'd still hang on to 31 cents of your premium, right? More than 2% for 2 weeks. That's nice. Then you could turn around and think about whether or not to go to 6 that you have to work with. And if you don't want to, that's fine too. There's nothing wrong with that. But either one of these, either the 1650 or 17 for 1 week, pretty interesting. I'm not going to lie. Now we do have earnings coming up, and that's going to be next week. And so the caveat to everything that I'm talking about is before you place this trade, think about what the stock usually does around earnings. It's fair to say, like most stocks, is pretty okay. But for this stock, it's not unusual to see some volatility around the earnings statement, right? And for a lot of stocks, that's true. That's generally true. So if you are thinking about being an active roller, or you're thinking about placing a trade across an earnings announcement, you need to factor in whether or not you're willing to deal with that potential volatility. And remember, it could work in your favor, could work against you. 50-50 odds. Frankly, it's a flip of the coin as to which, because there's no way to predict what it's going to do. So that's the decision. Barry says, I'm not typically a roller. However, I did for my NVDL trade. It felt foolish not to. Hey, I get it. Sometimes the numbers are just too good. Going back to my comment about earnings reports, this will make me think twice if I wanted to work with this a little bit more actively, but it doesn't mean I won't. It just means I need to think about it a little bit. We do still have, since these are coming up on expiration, or coming, so. All right. Any other thoughts or comments about Barrick Gold before we move on? Take a look at some of the other positions that are on deck right now. And while we're waiting, I'm gonna take a drink. So hold on just 1 second. Calls and this week's put sale. These were all very short-term trades. So let's go ahead and dive in and take a look at those. And then we'll look at Tyson as well as Borg Warner. Getting some interesting movements on some of these. Okay. So Hal again, Halliburton. This was the trade that I placed this week, selling the $26 strike price. I was able to bring in 42 cents with that overall result. So let's take again, remembering. Oops. Remembering that we are talking about stocks at the bottom of that are in downward trends, right? This isn't just a little bit of a contrarian philosophy, but this is kind of one of the linchpins of value investing is that we're really focusing on stocks that are deeply discounted. And so sometimes that means the bearish momentum continues to work against a really significant rally. So you need to factor that in to what you're thinking about. The stock right now is at 25.54, so it's below the strike price that I sold. That means that technically that means I could be assigned right now. These are American style options, and that means if the stock drops below the strike price that you sell when you're put selling, means that you can be assigned at any time. Buyers can exercise options anytime, American style options, I should say, anytime that the price moves favorably in the direction of their trade. So we're talking about a put sell, and somebody buys my put contract. What am I selling them? I'm selling them the right to force me to buy shares of that stock at the strike price I've sold. The only reason they're going to want to do that is if the stock is below the price. The only reason they'll want to exercise that option is if the stock has dropped below the strike price of that option. Now, right now, that's not so far below to create the kind of advantage that is going to really prompt someone to want to exercise that option right away. But it could. You never know what some people are going to want to do. We do see the stock holding pretty well at support right now at about 25.52. So we'll see if that continues. And in the next 7 days, it could maybe start to consolidate a little bit. Maybe we'll see some movement from this level of support to looks like resistance should probably be maybe around 27. So maybe we start to see a new consolidation range down in this area. If it bounces and it rallies higher, then that'll be good for the contract that I've sold. If it's anything above 26 at expiration, right? But even if I get assigned, let's say that it drops and it stays below 26, but it's holding in this consolidation range, that would actually not be a bad assignment to take, right? This is a stock that I really like. I've found it to be more than useful to my purposes. And so if I am assigned, as always, I'll take that assignment. And, it's not got a huge dividend yield, but it's got enough right here, 2.67%. So if I end up holding those shares, that's fine. If it rallies up above it all in the next 7 days, then I won't be assigned. So we'll just have to see how that shakes itself out. But I'm okay with this right now. Just a couple of days into it, and so that means that there's really not been a lot of opportunity to see the price of the option change a ton. Let's go ahead and take a look at where this one is. Selling the 26 put. Right now, 68.72 on the ask. And of course, I brought in 42 cents on this. So if this were something I was afraid of right now, is worried that maybe I could be setting myself up for a stock that might be about to extend that downward range, that downward trend even more below 26, then I could buy it back, but I'd have to eat a little bit of a loss. Personally, I don't see the reason for doing that yet. And the truth be known, even if it does drop significantly below 26, that's still not going to sway me from taking the assignment at 26. I like the company that's got the value proposition is really nice, and I like the fundamentals. There's enough here to like to go ahead and let this play out. So we'll see where it goes and what happens. But that's not a terrible thing. Just remember, if you're following these same trades, you need to decide for yourself if taking an assignment is something that you're willing to do, and if so, that's great. If not, then you need to think about how you're going to manage these trades. I'm not saying one approach is better than another. I try to present rolling options and active options for managing trades actively, as well as the more passive approach that I follow, because I want to be able to help you understand that there's a lot of different ways you can place these trades and manage a good income generation system. A lot of the active rollers that I know by now, they may have gone ahead and gotten out of how this quickly, even just after a few days. Get out, let their capital sit for a little bit, let the weekend pass, and see what the new week brings, and then go and look for the next trade, and that's okay. If you are in favor of a more active trade management approach, that it actually kind of becomes necessary to limit your losses more than what I do with my more passive approach, because you're excuse me, part of the objective in that case is to try to avoid taking large assignments. And even with, I remember when I say large put a sell assignments, I'm not implying that anybody is placing more contracts than they should. I'm saying even within any reasonable position sizing strategy, active trade management means that if you're in a position that where the stock is moving against you, and if you're worried about having it move further, it's usually better to act quickly than to try to wait and move on to before you let it play out. It's usually better to move quickly, be nimble, and do what you need to do to get out before you plan your next trade. So, okay, I hope that helps. You have any other thoughts on these on Halliburton right now? Anybody else want to compare notes for what they did? I tend to be more active with trades, and I'm not as familiar with the underlying stock, and that's fair, right? That's one of the things that I think is worth. I appreciate that comment, I really do, because this is just there is a difference. There may be a difference between a stock that maybe you're just starting to get to know. Maybe it just came across your desk because I sent it over to you, not really looked at it before. Just because I may happen to really like the company doesn't mean you do, right? And so if you're not familiar with it or you don't like it as much, yeah, it's okay to be more active. And then if there is something that you do feel a little bit more comfortable with, it's okay to treat those. It's okay to treat different stocks in different ways. There's nothing wrong with that. I have stocks for sure that I put into my category of legacy positions. They're stocks that I'm willing to hold for a much longer time, and I'm more comfortable with with dealing with their volatility. I'll be honest with you, one of them, if you've read my report already on Substack on Dow, this is one of them. Dow is a company I use quite a bit over the past few years for a lot of different trades. And this, seeing the stock down here below $40 really makes me kind of champ at the bit a little bit, because I really like the company. I consider this one of kind of my legacy positions. At the same time, there's some things going on with some of their fundamentals. They've dipped in. They're spending more money than they're bringing in right now. Free cash flow is dwindling down to next to nothing, and those are significant enough concerns right now that even though the value proposition looks pretty nice, I'm going to wait. I feel like this is a stock that should see those numbers improve before I start to look for it again. But I keep my eyes on it all the time. So, okay. Thank you, Barry. I appreciate that comment. Okay. Some of the others that we have on deck. Here's a covered call on Nike. I was assigned this stock at $74 beginning of January, and had an opportunity at the end of the month to sell a covered call here at 77. Let's go ahead and check in and just see what that's doing right now. All things being equal, it looks like I'm going to still continue to hold on to my shares. Stock is now down below 70, and it's dropped very quickly from that $77 level. So really nice to bring in that premium. Unless we see a significant rally in the next week, it looks like I'm going to hang on to those shares a little bit longer. That's okay. That's not so far away from my $74 owner assignment that makes me feel terrible. It looks like this could be breaking pretty major support. And I apologize for a really ugly line, but we've got significant support that the stock had been using based on all of these pivot lows, and it looks like we may be breaking down below it. This could possibly be picking up a new wave of bearish momentum to extend the downward trend. To be totally fair. So, yeah. Barry, I was assigned NVDL last Friday at $52. 3-day trade with $250 premium. On Tuesday, wrote a $53 call for $90. For $90, I mean, it looks like, so 90 cents per share. Yesterday, bought back the call for $220. Okay. And wrote $55 call for $3. Okay. Gotcha. So let's take a look at NVDL on this one. Yeah, it is very volatile. I will agree with that. Big gap right here. This is an ETF, so keep that in mind. Friday at 52, so this was the strike price you've been working with and that you've been assigned. Tuesday wrote 53 for 90 cents. You bought that back. You took a little bit of a loss on it. Friday, Thursday. So here, and then you wrote the $55 call for $3 next Friday. Yeah. Most ETFs are not that liquid. That is true, as the number of ETFs dramatically increased, right? You see a lot of them that are get a little bit less activity. That also means that their options tend to be a little bit more thinly traded. That's for sure. And so that's something that you have to factor in. But overall, it looks like you're doing okay. And if you do get called out at 55, then you've got a nice overall result, a $3 profit on top of about 80 cents net premium. As the name suggests, it's tied to NVIDIA. Right. Long NVDA daily ETF. So where NVIDIA goes, this is going to go as well. Okay. So we were just talking about Nike a minute ago. This is starting to, it looks like it's starting to increase in bearish momentum. Is it going to continue to? It could. It very well could. Now this is already a screaming bargain at around the $74 that I was assigned. It could get cheaper. So we'll see where this goes. But it's been following a downward trend for the last 2 years. That could continue. That could extend itself further. But the longer this continues, this is the thing. This is one of the reasons. This is one of the reasons this contrarian philosophy comes to play so often. Is the longer a trend extends itself, the more likely it is to reverse. Extended downward trends, bear markets, and this is, to be clear, Nike is in its own bear market, has been for the last 2 years. The thing is, these kinds of extended downward trends tend to, it's kind of rare to see them last more than a couple of years. So the longer this lasts, the more likely it is to reverse back to the upside. At some point, the market is going to recognize the strengths that Nike has in place, and we're going to see the market start to pick the stock up again. I'm not saying it's going to happen right away, but this is the idea. All right. Also, a covered call on LRCX that is scheduled for expiry in a couple of weeks. Here we are, LRCX. Actually, next week, excuse me. We're still talking about that. I brought in $2.19 on this, selling the $81 strike price after being assigned this one in October of last year at about $80 per share. And so right now, this is in a really nice spot for me. It's picking up, unlike a lot of the stocks we've been looking at today. It is down a little bit today, but it's actually picking up some bullish momentum. It's got some resistance here, right at the 50-day moving average. So right around 84. We'll see if it's able to break above it. If it does, it could continue this surge back upward again. So we'll see where it goes. Last earnings report looks like it came in pretty favorable. I have not had a chance to run through those numbers, but that will be another interesting one to do. Yours is next week at 82 for $1.50. Okay. So you baked in even more capital gain, Barry, than I did. You brought in a little bit less premium, but you also factored in an extra $1 of potential capital gain. And that's okay. I like it. These are just different variations on a theme. So I'm going to give you one, and I'm going to give me one. We both did okay on this one so far. This is looking pretty nice. Oh, and Barry, I'll give you one for what you're doing with NVDL to manage that as well, because I like it. I like it. You're following it. You're you're doing some good things with that position, I think. So, okay. Go out beyond the 14th, and we have a couple of positions, a covered call on Borg Warner, put sell on Tyson. Let's start with Tyson, since this is the one that this, again, the cash secured put. But remember, these are all pending positions. These are trades where we could be forced to deal with a put sell assignment at any point. So I sold the $55 strike, bringing in about a little over 2%, $1.15 on this one. And we have Tyson right now a little bit below 58. Looks like it's hitting some resistance right at 58. But we've also got support. There's obviously major pivot support all the way down here at 54, but also trend support is starting to build. And the 20-day moving average is starting to bend in the same direction, kind of in parallel. And so we kind of see support starting to build here, narrowing the distance between support and resistance. Again, implying that we could be seeing we could see a break to the upside here pretty quickly. So at 55, I'm in a pretty good position on this one. Let's go ahead and take a look at this. We're a couple of weeks from expiration on this. At 55, I brought in, just to revisit the numbers, $1.15 on this. My friends who prefer to roll, Barry, going back to LRCX, wrote several ranging from 80 to 83. There you go. So, okay, Barry, you've been more active about your covered calls on LRCX than I have. So now he's got one more tick. You're winning in the tick game, right? There you go. Okay. So I brought in $1.15 on this with the $55 strike. If I wanted to buy this back right now and try to leverage the fact that the stock is still a couple of weeks from expiration, and maybe I wanted, this doesn't have weekly options, so there's where I become a little more active once I own it. Hey, looking for opportunities and taking advantage of opportunities to pay yourself your own dividends and not even having to wait for the actual dividend distributions with covered calls. That's part of the beauty. I like it when people are actively looking for these covered call opportunities because they just are going to work in your favor. So this is one. It doesn't have weekly options, so there's not kind of the same options for rolling in this case, unless you want to go out a little over a month. But what this would do, if I were to buy this back now, I'd still hang on to $1. This was a 3-week trade. I could shorten it to 1 week, and I'd still be hanging on to a little under 2% of my premium. And then I get my $5,500 back. I sold one contract, so I could get my $5,500 back in from reserve and have some more flexibility to go redeploy that maybe in a different stock. That's not terrible, depending on what your preference is. I like Tyson. I'm going to go ahead and I'm going to let this play out and see what happens. Yeah. Barry, I skipped Tyson mainly because it is monthly. Monthly options, a lot of these stocks tend to not have as much activity associated with them. And so they tend to not move as actively. However, a lot of open interest, a lot of volume on that contract right now. So liquidity would not be a concern. But here you go. If you wanted to consider rolling out to take a little bit more time. 57.50. It's about not a little bit, probably a little over 2.5%. This is what I mean about what you deal with. You'll get a little bit lower level of open interest. This is enough to still keep these contracts be pretty responsive. If you were to try to place a trade here, you'd probably be able to do it. Day's volume implies that you may have to wait a little bit to see it work out. Okay, so that's Tyson. And then the last one was a covered call on BorgWarner. I was assigned on this one. Here we go. In December, just before Christmas at 32.50. And then I had an opportunity to place a covered call at 32.50 in the first week of January. So let's go to BorgWarner. And we're seeing it pick up bearish momentum right now. A lot of bearish momentum, in fact. Market's not responding so well to its latest earnings announcement. It's going to be interesting to parse those numbers and see if maybe that's an overreaction. But there was a lot of volatility on this just yesterday. That's a oops. Wow. How did I get it to an arrow? There we go. There's a low around 30 yesterday, a top end around 33, just in terms of its daily activity. So there's a big swing from high to low, and the market is continuing lower. I guess I should probably make these red. So it looks like it's picking up some bearish momentum. Now that's not going to automatically make me want to get rid of the position. Still holding these shares, but it does look like the odds are higher that I'm going to hang on to them for longer right now. Still a couple of weeks from expiration on this. This is another one like Tyson doesn't offer weekly options, so monthly is kind of the way that this one works. This could be an advantage, giving it the time to play out to expiration and seeing if the market can rediscover some bullish momentum. Again, this is another one that's in a protracted downward trend, not quite as long. But this one goes back to mid-2023. So it's about 18 months. It's been languishing for a good part of the year. Low end here is down around 29, which has been testing that level. We'll see if it is able to hold 29. Could go lower. So if you're in BorgWarner, if you've been in it like I am now, it is interesting to see it trying to hold support here around 29. But recognize it's possible it could go lower. It has. Here's a low in September 2022, around 27. Extreme low during the pandemic in 2020, down around 15. So could go lower. We'll see. I don't actually expect it to, but again, we'll see. So, okay. those are all the those are all of the open uh, put sales and covered call trades that I have right now. Let's go ahead. We've got a few minutes left in the live stream, so I want to open this up to some of the stocks that some of you may be paying attention to. You want to throw out. If there's any others, then feel free. Let's see what's happening with them. Okay, Barry has Magna International, so this is a competitor or industry brother with Borg Warner. Magna International 4250 call for 221, so 2 weeks to expiration with a $1.20 premium. Okay. What's the price you bought MGA at? Is going to be the real question there, Barry. Okay, still from our last assignment. Okay. $42.50. Okay. You brought in a $1.20 in premium on that $42.50, so you're selling the same strike price that you bought the stock at. That one goes back a little bit. Here we go. I was called out of this one back in October. This was an assignment from September of last year. So, not to say this is just comparing notes, just the difference between the way the different traders are going to work with some of these. Yeah, written several calls ranging from 42.50 to 45. And so you've got a 42.50. Obviously, the stock is kind of it's picking up bearish momentum here. Gosh, how is it that I got? There we go. It's picking up some bearish momentum. It's got a lot of resistance here around 42. And your 42.50 strike price is right about there. Gap down. This was some of this momentum the Magna's got seeing right now is going to be kind of a sympathetic reaction to what happened with Borg Warner. These guys kind of exist in the same space. They provide auto components to major auto manufacturers, including electrical vehicles. Both do. They also have significant footholds in the aftermarket. And so that's something that makes them interesting an interesting way to work with the auto industry without actually buying any of the major automakers. Just why I kind of like them. It's like buying. It's like working with the guy who's selling the pitchforks or selling the mining equipment, I should say, rather than going and actually digging for gold in the mine. Being the guy who's working with the guy who's giving them the equipment. But right now, it's again a couple of weeks to expiration, so we'll see if this can reverse. But kind of like Borg Warner, it's got some bearish momentum turning against it. This 20-day moving average is bent lower as well, so we'll see. CVS, a lot of things kind of going. What we're seeing in these stocks is the net effect of what happens when the market is uncertain. This is market uncertainty, guys. This is the way that the market reacts. And this is why I started the session by looking at the indices, right? This looks like one thing. Maybe it doesn't look all that scary. And then when you start looking at individual stocks, you get a little bit of a different view and understand this is how that broader view plays out on individual stocks. CVS, you've got a $60 call. Barry, you're in at a cheaper price on CVS than I am, if I remember right. I'm in at this at about 64. And so got a little bit longer to wait. And it is right now bending down. Used resistance at the 200-day moving average. It's clearly moving lower. Maybe using the 20-day moving average right now as a little bit of support. Yeah, you've got a $59 assignment. There we go. So we'll see where this one goes as well. Really interested to see what the earnings report for these guys looks like. They've not been immune from some of the pressures that are affecting the market in terms of interest rates, cost increases. They've had to shutter some stores. They're also in the midst of boy, sorry, the language is escaping me right now. Remodeling and adapting a lot of their stores from being drugstore only to drugstore and health clinics at the same time. And so they're in the midst of all of that, and there's a lot of other things that are going on. So a lot of uncertainty they're trying to navigate right now. It's one of the things that's also affecting the other national drugstore company in the U.S. that is publicly traded, and that's Walgreens Boots, which has obviously not been a great performer for quite a while. All right, Barry, one of my few bright spots right now is Walmart in at 60 after it's split. Yeah, darn for you. Walmart's been performing pretty strongly, so. Barry just wants one more of these. So there you go. I'm going to give you a Roman numeral instead. All right. Well, that's great. We are coming up on time, everybody, so I do appreciate your time. As always, I hope you have good plans for the weekend. Try to stay safe, look after, spend some time with the people that you love. I hope you have a great week. 950 put that expires next week for Walgreens Boots. That one, I'm in on this at a much higher price, and so we'll see where this goes. But it's got a ways to go to recover to where I was originally assigned. Been sitting in it for quite some time. That's okay. It's one of only 2 national publicly traded drugstore companies left in the U.S. Everything else has either been consolidated into companies like CVS or Walgreens Boots, or we're talking about Walmart, Costco, even Amazon's pharmacy operations have been working have been playing in that market as well. So, all right, everybody, thank you for your time as always. Again, as I mentioned, I hope you have a wonderful weekend. If you do have questions, don't hesitate to reach out to me. You can chat me in Substack. You can chat me in Discord. Send me a direct message in Discord if you like, or send me an email, rebelincomesystem@gmail.com. Thanks again. Talk to you again next week. See ya. Thank you, Barry. You as well.